Hi all, and welcome to a new class of Principles of Macroeconomics. Today, we are going to talk about money growth and inflation. Let's get into it. With this chapter, we are going to conclude our theory of money. Now, in chapter 16, we introduce all the definitions, what is money and how to measure it, and the institutional setup, how the Federal Reserve can control the money supply. In this chapter, we are going to put our macroeconomist hat and try to understand the interplay between money supply and macroeconomic variables. So, what are we going to learn in this chapter? First of all, we are trying to understand how money supply affect macroeconomic variables like inflation and nominal interest rates, concepts that we have introduced in chapter 10 and chapter 11. Then we're going to move and try to understand whether the money supply has actually a real impact in the economy in the very long run. Does money supply affect real economic variables like real GDP, unemployment, and so forth? Finally, we've introduced this concept of inflation, and this is a concept that floats around in news and etc. So the question is that how inflation is like a tax. We're going to show that actually there is something in common between inflation and tax. And for the purpose of understanding the macroeconomic impact, are the cost of inflation high? How serious they are? These are all this is basically all the objectives that you are going to cover in this chapter. In conclusion, in this chapter, we are going to introduce some very useful theoretical concepts, like the one on money neutrality and classical dichotomy. In addition, we are going to introduce a very important theory, the quantitative theory of money, which is going to be useful in order to explain one of the 10 principles of macroeconomics that we have seen in chapter 1, which is that prices rise when the government prints too much money. Now, economists believe that actually this quantitative theory of money is a very useful theory for understanding the long-run behavior of inflation. The quantitative theory of money is just a theory of money demand and money supply. Now, we have seen in the previous chapter all about the money supply, how the Federal Reserve can control the money supply, the different definitions of money supply, all the institutional setup. Now, what we are going to do, basically in this chapter, it is to close and talk about also the money demand. Now, in order to present the theory, we are going to use two approaches. The first approach, we are just going to use a simple supply and demand diagram, so a graph. Then we're going to also complement this approach with a more formal approach where we introduce an equation, what is sometimes referred to as the quantitative equation. So, first of all, when we have a graph about, when we want to draw a graph about money demand and money supply, as in all the graphs that basically that have to do with demand and supply, we have quantities and we have prices. So in this case, clearly the quantity is about money. But what is the price of money? What is the value of money? Well, we need to specify what it is. So let us discuss the value of money. In our previous class, actually, we started thinking about what is the value of money. In particular, if you remember, we asked ourselves, do we care about money? Do we really care about money per se? No. The answer was really no. We care about money because we can make transactions with that. So no money, no honey. If we don't have money, we cannot make a transaction. So we can go back to the barter economy, whether if I want to get an haircut, I need to find in Boulder an hairdresser that basically wants to hear about macroeconomics. So when we think about the value of money, we really think about the transactional value of money. The fact that without money, we cannot get the goods. So no money, no honey. So we do not care about money per se, what we want money for is just to make the transactions, to buy, if you want, goods and services. So the value of money tell us how effective are these fancy coupons called money in order to buy goods and services, which depends on, of course, how scarce is money with respect to goods. So we can at this stage inherit whatever we learn from microeconomics in order to understand the value of money, in particular the transactional value of money. Before jumping directly into the value of money in terms of the goods, let's look at the respective case. Let us look at the value of goods in terms of money. What is the value of good in terms of money? So here, as you can see in this figure, you have a good, a burger, and what is the value of good in terms of money? Well, it's just the amount of money that you need in order to buy the burger. But what is the amount of money that you need in order to buy a good? Is the price of that good. So the value of goods in terms of money is just the price. So inflation is a measure of the increase in the price. So what inflation measures basically measure how the amount of money that are needed to buy the same good increase over time. So inflation measures the increase of the value of goods in terms of money, which is a measure that tells us that there is a reduction in the value of money. You need more money in order to buy the same amount of goods. So something that we are going to try to understand in this chapter is how monetary policy, by affecting the money supply, causes inflation. And the intuition actually is going to be very simple. If the amount of money in the economy increases, then money becomes less scarce with respect to the goods, especially if money grows more than what the goods grow in the economy. So it's the excess production of money with respect to the excess creation of goods in the economy that causes inflation. So for the same amount of goods, let's suppose here you have a burger, now you need over time more money to buy the same amount of goods. So the value of goods with respect to money goes up, but inflation, which is caused by the monetary policy printing too much money, causes the value of money to go down. So now we are ready to understand the value of money in terms of the goods. And again, let's suppose that in 1972, with $20, you could buy these amounts of goods. This one will be the value of money in 1972. Now, if there is inflation, which means there are more and more money going around the economy, then this money will start buying less of the goods. So over time, the value of money goes down in presence of inflation. So the value of money, generally speaking, tell us how effective is this good called money in buying goods and services. And of course, decreases with increases in prices, so decreases with inflation, that as we have seen in chapter 11 and also chapter 10, measure the growth in the prices in the economy. So the value of money is intrinsically related to the price, which is the value of the goods. In particular, if P is the price of a basket of goods, think about the trade we have seen before, measured in terms of money, the CPI or GDP deflator, then the value of money is just the reciprocal of the price, is 1 over P. So 1 over P, what it measures is the value of $1 in terms of goods. And as an example, if the price of the basket of goods is $2, the value of $1 is half of that good. In this particular case, a candy bar. If the price goes up, with the same dollar, you can buy less goods. You can buy less candy bars. So inflation, which increases prices, drives up prices. As a result, what it does, drives down the value of money. Drives down the value of money, which is given by 1 over P. Oh, this is a beautiful clicker question. So let us look at it. When the price level falls, which means when price go down, then the number of dollars needed to buy a representative basket of goods, what it does, increases, decreases, and then eventually accordingly whether the value of money rises or falls. Well, when the price level falls, means that you need less money to buy the same amount of goods. So what does it mean is that the number of dollars needed to buy a representative basket of goods decreases. But then if you need less dollars in order to buy the same amount of goods, means that dollars are more powerful. They can buy more goods. So this means that when the price level falls, the number of dollars needed to buy a representative basket of goods decreases and the value of money rises. Now the value of money is equal to 1 over P. So if P goes down, the denominator goes down, the value of money goes up. Okay? And by the way, the number of dollars needed to buy a representative basket of goods is the definition of a price. So if the price level decreases, the number of dollars to buy representative goods decreases. So the solution is C. Wonderful. So now that we know how to measure the value of money, and also we know how to measure the quantity of money, we have seen this in chapter 16, where we discuss about the money supply, M1, M2, and how to measure the money supply. Well, we have all the pieces in order to discuss the quantitative theory of money. So the theory of money demand and money supply. Now, in terms of the money supply, we can refer to chapter 16. Okay, here we just do a very brief recap, which is in the real world, the money supply, particularly in the United States, it's not on the entire world. In Europe we have a different central bank, but in the United States, the money supply is determined by the Federal Reserve. And in particular, the Federal Reserve interacting with the banking system that, as you remember, by making loans, they create the multiplier effect. And it relies on consumers putting their currency into banks, so using the banking system. So in this model, we are going to assume that this complex interplay between Federal Reserve, banking system, and consumers that determine the money supply is actually not so chaotic. So we are going to assume that the Federal Reserve can exactly control the money supply. Okay? So if this is the money supply, if this is a graph with money as quantities here, and this is the value of money here, which is, by the way, is equal to 1 over P, then the Federal Reserve controls perfectly the money supply. Okay? Can move the money supply perfectly. What is the money supply? Again, measured as M1 as currency plus demand deposits. Okay? Look at chapter 16 if you want to remember more details about this. So let us now move to the money demand. Now, we discussed a little bit about the money demand in chapter 16, but now we want to formalize what is the money demand. Now, in chapter 16, we really discussed about the money supply, and we mentioned that, we would have talk more about the money demand in chapter 17. Now is the time to do that. First of all, what is the money demand? In order to understand what is money demand and therefore what are the determinants of money demand, we really want to find an answer to the question why people want to hold money. And actually, we kind of already know the answer. People want to hold money because they want to make transactions. So the money demand is just the amount of cash that you have in your pockets or the demand deposits that you have at your bank. Think about as you having a pile of wealth or some income, and then you have to decide whether to allocate this wealth or income in more or less liquid assets. So money is something that is very liquid in terms of assets. So it's kind of assets that are easy convertible to currency or are accepted to make transactions versus other more illiquid assets like could be houses or investment in stock, investment in very long-term bond, and so on and so forth. So the reason why you demand money, so you demand liquid assets, that has a cost, right? Because we renounce to the interest rates that we could earn on liquid assets. This is something we are going to see. But the reason why we demand money is because we want to make transactions. Okay? So what we are trying to do in order to understand money demand and what are the determinants of money demand, we're going to try to understand what is the cost of keeping your wealth in liquid assets. So what is the money demand? With our wealth, we can do two things. We can keep it in the form of liquid assets, which is currency, demand deposits, traveler's checks, and so on and so forth, or non-liquid assets, which are given by long-term bonds, real estate, and so on and so forth. Now, what is the money demand? Is if you want the share of your wealth that you want to keep in liquid form, in the form of assets that are easily used in order to make transactions. So now that we know what is money demand, that is the share of wealth that you want to keep in very liquid assets in order to make transactions, we want to ask ourselves, what are the determinants of money demand? And of course, this is really related to the transactional value of money. We want money because we want to make transactions. Therefore, the money demand depends on the price of the goods that you want to buy. In particular, if there is an increase in the price, which reduces the value of money, which means basically you need more money in order to buy the same amount of goods, then you will need more money in your pockets to do this. And therefore, an increase in price increases your money demand. So the money demand is negatively related to the value of money, which means the more powerful is your money, the more for each one of these fancy coupons you can buy goods, and therefore you keep less of these fancy coupons in your pockets because you can buy more stuff with less, and of course is positively related to the price. The more money you need in order to buy any good, the more of this money you need to keep in your pockets or in the bank in order to make these transactions. Okay, finally, we have all the pieces of the puzzle in order to present our quantitative theory of money in a graph. In particular, we have we know how to measure the quantity of money. For this, look at chapter 16. We know what is the value of money. We discussed this at the beginning of the chapter. We know what is the money supply, controlled by the Fed. We know what is the money demand. So let us put all these pieces together in a graph. This graph has on the horizontal axis the quantity of money. If you want, this one would be M1 or M2, and this is basically the quantity of money. On the left-hand vertical axis, we have the value of money, where the value of money measured in terms of goods is equal 1 over P. The higher is the price, the less good I can buy with the same amount of money. But on the right-hand side, on the vertical right-hand side axis, I have the price level, which is just P. So you can see that the left-hand side is just the reciprocal of the right-hand side. On one side, we have the value of money in terms of goods. On the right-hand side, we have the value of goods in terms of money. Here, value of money in terms of goods. Wonderful. So as the price level falls, so as the value of goods in terms of money falls, the value of money rises. Okay? And you can see that we can measure here in this way. You can see that basically the right axis goes from high level to low level. So this denotes a price fall. Okay? And at the same time, the value of money instead is an increases axis, goes from 1/4 to half, 3/4, 1, and so forth. So as the price level falls, a decrease in the price level, the value of goods in terms of money goes down. Here is from 4 to 2, while the value of money goes up from 1/4 to 1 over 2. And it keeps going in this process. Now let us draw the money supply and the money demand in this graph. So the Fed sets the money supply as some fixed value regardless of the price. So this, you can think about this one as $1 trillion, is the money supply that is set by the Fed. And please look at chapter 16 if you are curious to know how the Federal Reserve sets this number. Then, what is the money demand? Well, the money demand, we are going to assume that actually depends on the price. And we have seen it before. Again, we care about money because we want to make transactions. No money, no honey. So a fall in the value of money, which means an increase in the price, what it does increases the quantity of money that you demand, right? That is actually pretty intuitive. The less powerful is your money in terms of goods, buying goods, so the more money you need for any goods, the more of money you demand. So when the price is very, if you want, high, which is basically here, then you demand a lot of money. When the price instead is low, let's suppose is 1.33, you demand less money. So this is the money demand when the price is equal to 4. This is the money demand when the price is equal to 1.33, which is much, much less. And the reason is always intuitive. You want to make transaction, the more money you need for any transaction, the more money you will demand. So we can put together the money demand and the money supply. Again, the money supply is controlled by the Federal Reserves, while the money demand depends on the demand for transactions. No money, no honey. So P adjusts to create the quantity of money demanded with the money supplied. So P, the price level, makes basically the money supply equal to the money demand. So let us now make an experiment and see what happens if the Federal Reserves that is in Washington decides to print more money, decide to increase the money supply. Suppose the Fed increases the money supply from 1,000 to 2,000, say from 1 trillion to 2 trillion. So what happens? Well, at the beginning, at the price level equal to, which was the equilibrium price level, there is an imbalance between money supply and, say, point B, and money demand. In particular, there is more money in circulation than what period people want. So what people will start doing? Well, we start basically using this money in order to make transactions, or if they don't want to make more transactions, well, they just lend this money and someone else will make this transaction. But remember here, the only thing that has changed is the money supply. So output, the goods that are in circulation, are always the same. So if output is the same, so there is the same amount of goods in the economy, and now basically you have more money, what will happen? Well, we just use more money to buy the same amount of goods. So the price will increase. Okay? And the price will increase in order to make the money demand equal to the money supply. Just intuitively, think about a class. This is an example I usually do in class, which is the following. Think about a class of 100 people. Each one has $1, and each one produces one good. And each one of the people in the class wants the good that is produced by, say, the person on the right-hand side. Now, what is the price level in this economy? Let's suppose the goods are equally scarce, takes the same time to produce them, and etc. So the price of each good is, let's assume, is $1. Now, so there are 100 people in the class, they produce 100 goods, there are $100 in the economy, so the value of money is going to be equal to 1 over P, and the price is going to be equal to 1. Now, let's suppose that in this class, I'm going to double the amount of dollars. So let's suppose now that instead of having $100, now you have $200. But you have the same amount of people, 100. They produce the same amount of goods, 100 goods. Now only you have basically $200 to buy these goods. What is going to be the price? Well, the price is just going to double. It's going to be equal to 2. So as you can see, if the goods do not change, an increase in the money supply from $100 to $200 just affects the price. It does not affect the goods that are produced. So, to recap, an increase in the money supply causes an increase in the price. So how does it work? Very short version. At the initial level of price, which, if I remember correctly, was 2, an increase in the money supply causes an excess supply of money. We were, in this case, from A to B. Excess supply of money. And because of this, basically people have more money than what they want to keep. So what they start doing, they start spending it in goods and services or by lending it to others who can spend it. As a result, there is an increased demand for the goods. But the supply of goods, like in our class, is fixed, does not increase. We just assume that there is an increase in money supply, not that there is an increase in the goods. As a result, the price of each goods must rise. The goods become more scarce with respect to money. Or if you want, since price denotes the value of goods in terms of money, the goods become more valuable as expressed in terms of money. So the price must rise. Importantly, the important assumption is that the supply of goods, Y, is fixed. In our example in class and in this example, we are assuming that the supply of goods is fixed in this economy. In the short run, in particular when we go to chapter 20, you will see that things are different in the short run. So in the long run, which means when we are considering 3 or 4 decades as a horizon, an increase in the money supply just affects the prices. Why? Because the determinants of output, as we are going to see, are different, are real factors. In the short run, when we are looking at anything from basically daily up to a couple of years, then the monetary policy might have some effects. So changes in the money supply might also affect the output or the supply of goods. But at this stage, don't worry about this. At this stage, an increase in the money supply just affects the prices. Now, let us do a quick clicker question before moving to other interesting aspects of monetary theory. So here is saying if B denotes the price of a goods and services measured in terms of money, So P is the price level. Then 1 over P represents the value of money measured in terms of goods and services. Yes. P can be regarded as the overall price level. Yes. And an increase in the value of money is associated with a decrease in P. Yes. So the lower is the amount of money for each goods that is needed for each average transaction, the higher is the value of money. So the solution is D. All of the above are correct. Wonderful. So let's move to a new and important piece of monetary theory, which is the concept, which are the concepts of money neutrality and the one of classical dichotomy. And importantly, these theories are theories that hold in the long run. That is, when we consider basically, and we want to make predictions in economy, say for 3-4 decades. Okay, everything actually more than say 10-15 years. Okay, so real versus nominal variables. Okay, actually let me put a little bit this one in context. What the theory of money neutrality and classical dichotomy say is really the following. What it's saying is that the money supply in the long run, so in the long run, money supply affect nominal variables. But in the long run, money supply does not affect real variables. We're going to look at the definition of nominal variables and real variables, but just intuitively, basically saying that monetary policy, so the authority that controls the money supply, does not affect the real economy in the long run. There is no effect on the real economy in the long run, but affects only nominal variables in the long run. Now, this is something that is going to change when we look at chapter 20, where we start discussing about the short run. Now, monetary policy in the short run might have some real impact. So you can really think about as monetary policy, I don't know, helping the economy to get out of a recession in the short run. But the monetary policy does not determine why countries are growing more than other countries. Well, this, as long as monetary policy, and in particular inflation, is under control. If we are reaching levels of what is defined as very high inflation, like hyperinflation, then the monetary policy can have also impact in the long run. But for normal, if you want ranges of inflation, monetary policy does not have any impact on real variables, so on the real economy in the long run, does not explain why countries grow more than others, but only impacts nominal variables. So let us start by defining what are nominal variables and real variables. So nominal variables are just variables that are measured in monetary units. So that are measured, say, in terms of dollars. As instance, could be nominal GDP, could be the nominal interest rate, so the rate of return measured in dollars, the one that you can get basically at your bank, say 1% of basically the nominal value. Nominal wages, so dollars per hour worked. Prices, which is really, the definition is the amount of money that is required in order to buy a particular good. So as you can see, everything here is measured in terms of dollars. Dollars, dollars, and dollars. Now, real variables, conversely, are measured in terms of physical units, like a real GDP, that is measured in terms of the value of GDP in basically in corrected for the inflation. Then real interest rate, that is telling you how your money that you put in your bank account is growing with respect to the level of prices in that particular economy. Now real wages, which are measured in terms of output, relative prices. So everything here is that relative prices is, I don't know, how many carrots you can get in exchange of a chocolate cookie. Okay? So it's really telling you the ratio of the price, it's telling you how many goods you get in exchange of the other goods. Unemployment is an example of a real variable. So all of these are measured in terms of output goods, okay? In terms of physical units, not output goods, in terms of physical units. Unemployment is measure resistance in terms of the working population. So nominal variables, example, nominal GDP, nominal interest rate, nominal wages, prices. So the unit of measures is really dollars, money. Okay? So the nominal value of a good is its value measured in terms of money. Value of good in terms of money. Conversely, real variables are expressed in terms of existence, output, or in terms of physical units, okay, in terms of goods, the sense outputs, or more in general, physical units, existence, unemployment. Okay, existence, what was the real value of money in 1972? The amount of goods you could buy with it. What is the value of money in 1992? The amount of goods you can buy with it, and so on and so forth. Okay? Just to give an idea, what is real GDP? Is the nominal GDP corrected basically for the price level, just to give you an idea how many goods have been produced in a particular period of time. Okay, real versus nominal variables. Prices are normally measured in terms of money. Again, you have one good, which is, say, a burger, then the price is given by the amount of money you have to give in order to get that good. Price of a compact disc, existence $50 per good, per CD. Price of a pepperoni pizza is $10 per pizza. So prices are in general nominal variables. But relative prices, those are instead measured in physical units and is telling you the price of one good relative to another good. Existence, the relative price of CDs in terms of pizza, what it does, it just measure, if you want, how many pizzas do you get per CD, which is 1.5 pizzas per CD. So this ratio prices actually is telling you something about the term of exchange between two goods. And please look at your Principle of Micro course for a lot of examples on these terms of trades. So relative prices are measured in terms of physical units. So relative prices are real variables. Now, example, real versus nominal wage. The nominal wage is just telling you how much dollars you get, say, per hour work. While the real wage does not care only about how much you get in terms of dollars per hour. You really are interested about, okay, I get $1,000 per month. I want to know what I can buy with it. And so I had to divide this $1,000 by the price in order to know how many goods I can buy with it. So the real wage is measured in terms of output goods. So the price of labor is dollar per hour. The relative to the price of output, which is basically the amount of dollars you need in order to buy output, what you get as a relative price, you get how much output you can get with 1 hour of work. So if you want, the real wage is an example of relative price. Is the relative price of labor versus output. Price of labor over price of output, which will tell me basically how many output goods can I get per change in hours. Sorry, labor hours. This is a quantity, not the price. Again, you can look basically this at your course in Principle of Macro notes, Principle of Micro notes. Okay? Now, the classical dichotomy, what it says? It says basically that there is a theoretical separation between nominal and the real variables in the long run. And by the way, this is due to human. In particular, monetary factors like existence money supply, or for what concerns even money demand, affect variables that are expressed in terms of money, so affects the nominal value of these variables, but do not, and this one remember, do not affect real variables in the long run. So when we are looking at basically 3-4 decades, when we want to understand why countries grow at a different pace than other countries and so forth. So there is money neutrality in the long run. The concept of money neutrality is the proposition that changes in the money supply do not affect real variables in the long run. Okay? So in the long run, any change in the money supply does not affect the real variables. That's the only thing that you have to remember from this. So let us do some experiment. If I increase the money supply, do I affect the nominal GDP? Yes, I affect nominal GDP. Why? Because I'm printing more money, and therefore now it's like having a meter that now is longer. Now you have more money in circulation, money is less scarce, so the price of each good goes up. So an increased money supply affects nominal GDP. Does it affect the real GDP, the real amount of goods that have been produced in an economy? No, not really. The real GDP, the amount is the same. Money neutrality is the proposition that changes in the money supply does not affect the real variables in the long run. Importantly, I will not stop repeating it, in the long run. If central bank doubles resistance the money supply, what happens? All nominal variables are affected. Nominal GDP, say, let's suppose that the velocity, well, let me not complicate. So nominal GDP will be affected. Nominal interest rates, the one that you will see at your bank, will be affected. So the changes, say, before was 1%, now is 2%. Nominal GDP, say, was like 13 trillions, now is 26 trillions. Still, the amount of goods produced is the same. Don't worry, we are talking about just in terms of nominal, expressed in terms of money. Nominal wage will be affected. Prices will be affected. But real variables will not be affected. So, real variables will not be affected. As instance, real GDP is going to stay the same. Real interest rate, suppose it was 4% before the change in the money supply, still now is 4%. Real wage, let's suppose was $15 per hour, still, sorry, that's very wrong. This is the real wage. Let's suppose it was 3 output goods per hours worked, is still gonna be the same. Relative prices are gonna be the same. Unemployment will not be affected. All of this stays the same. Think about if I make you an exercise in the exam. Think about, I'm telling you what is the effect on unemployment. If unemployment was 5%, and I tell you that there is an increase in the money supply or an increase in any monetary factor like money demand, in the long run, there is no effect on these real variables. Okay, so a clicker to fix ideas according to the classical dichotomy, the dichotomy between nominal variables and the real variables. Which of the following is not influenced by monetary factors in the long run? okay? Price level will be affected by monetary factors. Nominal interest rates or nominal variables will be affected, but unemployment is a real variable. So this will not be affected. If it was 5% of unemployment, stays 5%, does not move. Okay? So the neutrality of money. Money is neutral in the long run. Changes in the money supply or in any monetary factor, like even changing the money demand, do not affect the real variables. So doubling money in the long run causes only nominal prices to double. What happens to the real prices? Let us look at it. Initial relative price of CD in terms of pizza is, let's suppose, is 1.5 pizzas per CD. Okay? It's $15 per CD, $10 per pizza, so it's 1.5 pizzas per CD. After nominal, after this increase in the money supply, let's suppose that the price double. So now the cost of the pizza the cost of the CD from 15 is 30, and the cost of the pizza from 10 is 20. Now, what is the effect in the long run on the relative price? Well, it's still the same. It is still 1.5 pizza. The idea is that if I have the ratio of any two numbers, if I multiply by the same number, say 3, this change will cancel out. So there is no change in relative prices. Same thing for the GDP. Py over P, they will cancel out. The real amount of output that is produced is going to be the same. Same thing for the real wages. If I double wages and I double the price, the real wage is not affected. Anything that is real, anything that has to do with changes, basically relative quantities, like the real wage is telling you how many goods you get per hour's worked, all of these are unchanged when there is a change in a monetary phenomenon in the long run. Importantly, in the long run. We will see in chapter 20 that in the short run, things might change. So, similarly, the real wage does not change. Quantity of labor supply does not change. Therefore, quantity of labor demand does not change. Therefore, total employment does not change. Therefore, total unemployment does not change. And the same applies to employment of capital and other resources. So here it just shows you more in detail why, if real wages don't change, that the quantity of labor supplied, well, remember, your quantity of labor supply, how much you decide to supply, depends on how many goods you can buy, basically by working. You know, if I don't buy many goods, I will not supply many hours if the wage is not so high relative to the prices. But then this means that the labor demand does not change. If the labor demand does not change, there is no effect on employment. Therefore, there is no effect on real GDP, the real production of goods in this economy. So there is no effect on total unemployment, and so on and so forth. So nominal factors like money supply or money demand in the long run do not affect the real variables because do not affect relative prices, like if you double E over double P, there is no effect on the relative prices, and therefore does not affect any real decision in the economy. Therefore, the real GDP is going to be the same, and therefore unemployment is going to be the same. Real GDP, since employment of all resources unchanged, total output is also unchanged by the money supply. Everything here in the long run. Okay? So, money neutrality and the classical dichotomy between nominal and real variable is a theory of the long run. Does not hold in the short run. Money indeed may have real effects in the short run. So the money supply will always affect nominal variables. This is independent of long run or short run, but it will affect real variables in the short run, but will not affect real variables in the long run. Okay? That is basically it. So, in general, economists believe that the classical dichotomy describes well the economy in the long run. So let us provide basically a framework about long run and short run. So in later chapters, we will see, in particular chapter 20, that monetary changes may have effect in the short run on real variables. So to recap and fix ideas, in the long run, money demand, let me go back. In the long run, money demand and money supply determine the value of money, yes. The real interest rate, no. The real interest rate is physically measured in terms of purchasing power of your balance sheets in the bank. So it's a relative price. So no, it's measured in terms of outputs. So it's not affected by money demand and money supply. So money demand and money supply affects the value of money, yes, but not the real interest rates. That's good. The real interest rate, but not the value of money. That's wrong, and that's wrong. Neither the value of money nor the real interest rate. That's so the solution to this is B. Okay, the money neutrality theory is telling us that in the long run, here, money demand and money supply affect monetary factors like the value of money, but not real variables like the real interest rates. So now let us basically present our quantitative theory of money by using another approach. Before, we have used this graphical approach. Now we are going to use a more formal approach that makes use of an equation. Okay? In particular, the quantitative equation. Let me provide you a very simple idea, basically how can we formalize our quantitative theory with an equation. Let's suppose that Y is equal to the amount of goods that are produced in the economy. Actually, let's think as this as the amount of transactions in the economy. Now, in a barter economy, each one of these transactions can happen only if I exchange one goods for another, one goods for a service. So we discuss about this. Now, we are in a basically monetary world where there is money. So what is the value of each one of these transactions in terms of money? Well, we know about this. We have to multiply this amount of transaction in the economy, which is a proxy, could be proxy by the real GDP. The real GDP can tell you what is the amount or the value, if you want, of the transaction in this economy. Now, P is equal the price. We tell you what is the value of this transaction in terms of money. Okay? And by the way, P times Y is equal to the nominal GDP. Okay? So, these are the amount of transaction in the economy. We are not in a barter economy. We are in an economy that has money. So what is the value of this transaction in terms of money? P. So say this is the nominal GDP, the whole amount of transaction that have to be made in this economy. Now, let's suppose that the Federal Reserve supplies this amount of money, MS. Okay? And this is given. It's controlled by the Fed. Now, the question we want to ask ourselves, if we have this amount of money, how many times this money have to circulate in this economy in order to purchase this amount of output? Well, V will tell you how many times money has to circulate to make all transactions. Let us make a very simple example. Let's suppose that MV equal PY. Let's suppose that output is equal to 100 goods, the one in our class. Let's suppose that price is equal to 1, okay? And let us suppose that we have $100 in our economy, okay? So the nominal GDP is equal $100. You have $100 in this economy, like in the example in the class. What is the velocity? What is the unknown velocity? Well, is equal to 1. You adjust to exchange $1 for the goods of your classmate. Go back to our example where we have 100 goods, 100 people, and $100, and you want the good of the person on your left-hand side. So you have 100 goods, each goods is value $1, so you have $100 on nominal GDP to buy. Each one of you will circulate $1 in exchange of the good. Clearly, if instead of having $100, you have, so let's suppose that you still have 100 goods of the value of $1 each, so you have $100 nominal GDP, but let's suppose that now you have only $1. Then how many times this dollar has to circulate in the class to make all the transactions? Well, suppose you start from the last row, then there is the first transaction between the first two students, one good for $1, and then this dollar has to basically go through all the class in order to finance all the transactions. So the velocity has to go is equal to 100. This dollar has to circulate 100 times in order to make these transactions. Let me repeat this experiment here. So, because I could see that you could not see, because there is the camera there. So let's suppose you have 100 goods in this economy. Suppose the price is 1, and suppose you have $100, then the velocity, which is our unknown, is equal to 1. Okay? If you have 100 goods in this economy, our class, and each one of the goods is worth $1, and you have only $1 in the entire economy to make all the transactions, then this dollar has to circulate 100 times. Okay. So we can define the velocity of money as the rate at which the money has to circulate in order to make all the transactions possible. So let us start with some notation. We have Y that is equal to the real GDP. So P times Y is the nominal GDP, which is given by the price level P times the real GDP Y. M is the money supply, V is the velocity, and V is the velocity if the velocity is defined as the number of times that money has to circulate in order to make all the purchases. So if this is the value of the purchases, and this is the amount of money in circulation, this ratio will tell you how many times money has to circulate in order to make all these transactions possible. So please remember this velocity formula. This is price, real GDP, and money supply. Let us make an example where as a good we consider a pizza. So Y, the real GDP, is basically composed just a basket of goods that is composed just by pizza. So in 2012, Y real GDP is equal to 3,000 pizzas. Then we need a value for the average pizza. So the price level of the price of a pizza is equal to $10. So the nominal GDP is equal to $30,000. Money supply, let's assume that is equal to 10,000. Now the question is, what is the velocity? And it is very simple, actually, how to find this number. You just divide the nominal GDP by m, so the velocity is 30,000 divided by 10,000, which is equal to 3. Money has to circulate 3 times in order to make these transactions possible. So the average dollar, the average, I would say, dollar bill, was used in 3 transactions. Clickers time. So let's suppose that the economy has enough labor capital and land to produce Y equal to 800. Importantly here, output, notice, is actually determined, as in chapter 12, by the production factors. So capital, labor, natural resources, human capital, and technology. Here in this case, they are not mentioning anything about technology and anything about natural resources and human capital, but the intuition is that the output in the long run is going to be determined by the factor of productions. This is something that we are going to explore very soon in order to understand the classical dichotomy more analytically. But let's suppose that there is enough labor, capital, and land. Actually, there is natural resources. There is land. Okay, to produce output of 800 bushels of corn. Let's suppose also velocity is constant. This assumption, actually, we are going to see in a second, is because actually in the data, the velocity is constant. It tends to be pretty constant over time. So in 2008, we assume that the money supply was $2,000. So that there were $2,000 bills in this economy. And the price level, let's suppose, is $5 per bushel. So the relative scarcity, if you want, the value of goods in terms of money is $5, 5 fancy coupons called money per bushel. So what is the velocity? Well, we can apply the formula. I always forget this formula, so let me rederive it. The idea you have all these are the amount of transaction that I had to make possible in this economy. The value of each transaction is given by the price. So I have this amount of money in the economy. So V is the number of times that this money has to circulate in order to purchase this output. So V is equal to Py over M. What is Py? Is the price is 5, output is 800, so is equal to 5 times 800, and the money is 2,000. So let us simplify. This is equal to 4,000 divided by 2,000 is equal to 2. So the solution is C. Money has to circulate twice. Basically, each dollar bill has financed or has allowed 2 transactions. So as I was mentioning, the velocity, so here I'm plotting a graph where I want to plot the relevant variables that are in this formula. In particular, I want to plot the nominal GDP, which is this guy here, the blue line. Then I want to plot money. In this case, I'm measuring money as M2. Look in chapter 16 at the definition of M2. And then eventually I want to plot the last quantity. So this is 1, this is 2, and then I want to plot the last quantity, which is given by the velocity. As you can see, velocity, which is this green line here, is pretty stable over time. It does not change. Nominal GDP has gone up, money has gone up. Why money has gone up? Again, the reason is that if there are more transactions in the economy, then we want money to be able to finance this type of transactions. So money always follows nominal GDP. And in general, real GDP. While velocity, so the average transaction per dollar bill, has been pretty stable over time. So the quantity equation, the velocity formula, well, just basically derive the quantity equation directly from this velocity formula. The idea is like we multiply both sides by m. What we get the formula we started from the beginning. So this formula here, m times v equal p times y, is called the quantity equation.
Ooh, that's a bingo!